Let's in fact go across to Shyam Srinivasan of Federal Bank. Mr. Srinivasan, good morning. Good to have you with us. Let's understand better from you the kind of NPA picture we're likely to see in Q2 in the coming quarters. What kind of disclosures that you'll be looking at as well?
Morning. Yeah, I think like you just mentioned, the moratorium ends today. So the situation from tomorrow, that's starting September 1, will start sort of unveiling what the picture will look like. I don't see anything material changing in September. The real picture will probably get clearer as we go into Q3. In our case, I think we mentioned in our calls the net moratorium as we disclosed at the end of Q1 results was 24%. Here I must remind you that the calculations or the reference different banks have used for calculating moratorium has been quite varied. We've been quite strict with the definition, and even if only if 3 or more payments had come at that point in time, they were treated as equal to having made a out of moratorium. We have not unflagged anybody. So if I apply the more generous definition, we would also be in the 10-12% range. So, but I think that doesn't mean much. The real picture, like I said, will emerge in the quarter in September and thereafter. We are reasonably okay. I would not say that it's clear to sort of able to predict what the outcomes would be, but all indications suggest that it may be quite along the lines we've planned and provided for.
Gold loan segment, Mr. Srinivasan, what's been the performance there? When we last spoke, it was showing tremendous growth.
That continues to be our strongest suite at this point in time and is performing quite well. You saw that in Q1. We had grown at about close to 9.5% for the quarter, annualized close to 37%. That run rate is only getting better and it's likely to hold out through the year. Gold is usually counter-cyclical, so whenever there are challenges in other areas, people sort of resort to gold, and we've been a very prominent player in that space. So that continues to do well. I'm quite hopeful it will be a very strong year for gold this year. In fact, very strong.
Would you like to add any numbers there? Any guidance that you could give us, considering it is going to be that strong a year for gold?
I think I'd mentioned in the call at the end of Q1 results, we grew for the quarter 9%. So annualized, we were running at about 35-36%. It should be there or slightly even better in the full year. Certainly Q2 will be good, but you'll have to see how each quarter plays out. Yeah, at this point in time, looks very strong.
Sure. Let's move on to the retail category then. Is it still showing signs of robustness when it comes to credit growth, growing quicker than the overall book? And also, is it exhibiting better asset quality, you think?
See, on asset quality, hard to tell at this point in time till moratorium gets over and people start servicing dues. But if you look at proxy of people holding money in their account, salaries credit into the account, people who have made at least 3 payments into the account, looks reasonably okay. And in a portfolio like ours, which is largely secured, as you know, we don't do unsecured at scale, it looks like it's holding out. But that said, people are nervous. People are wondering what the sort of next 3, 4, 5 months will look like. So it'll be a mixed bag. But as I see, like I mentioned, it doesn't look too adverse from what we had visualized it to be. So it should play quite on course to what we had wanted it to look like given the adverse environment. In terms of incremental business, I would say businesses like auto loan are moving in select segments, select geographies rather. Karnataka, Kerala seems to have picked up a little better. Parts of Maharashtra still sort of not at pace. So auto loan, home loan for us is running at about, if you index it to January of 20, is running at about 50, maybe 55, 60% at best in terms of monthly volumes.
Sure. Are the NIMs currently, which are pretty high already, are they looking sustainable to you? What could possibly impact those numbers going forward as well?
Q1 As you know, there were no slippages of any material nature. So typically, the NIMs are influenced by the margin of the businesses, then the reversal that happens in the low-cost funds. These are three pillars which usually influence the NIM. We had very strong growth on deposits, in particularly low-cost deposits, so that helped in Q1. There were no slippages, that helped. Gold loan grew well, that helped. In this quarter too, most of those still hold. You don't know how September will be, the first and only month of slippages in this quarter, but I think slippages for September are quite predictable because whatever was the ones that are held back in March 20 are the ones likely, if at all, to slip in September 20. So to that extent, the NIMs for Q2 should be on or around where we were at Q1. Q3, Q4, we'll have to see depending on how the slippages situation plays out. As of now, our guidance remains on course to what we had said at the beginning of the year, around 3.1 or a little more.
Okay. On capital raise as well, any plans ahead, especially when currently we are seeing the appetite and also just in terms of overall outlook going forward?
We have an enabling approval for 4,000 crores of equity raise. At this very point, we are not actively looking at anything. As you know, our capital adequacy is reasonably good. We are looking out how things are shaping up. We are positioned for any activity required, but as we speak, we are not looking at anything. But that said, there are interested parties who are looking at us as either as a preferential or, if required, the other instruments of QIP. So we will be able to advise more on that as we see how the quarter 2 and 3 shape up and what kind of provisioning is required, how the environment is. At this very moment, we are positioned, but really there's nothing that we're looking at doing as a transaction just now.
Sure. Any M&A, Mr. Srinivasan, on the radar to try and improve your reach?
Portfolio opportunities, certainly, Asha, if there are good portfolios that we can look at. But it will be wise for us or anybody to look at how the next, at least Q3 shapes up before you decide to plunge into those, because you do want to see how the moratorium impact is, how the restructuring books are performing, particularly the higher margin, relatively smaller ticket businesses, how they're going to be impacted by this pandemic. So if we do anything, it will be after we see the impact of at least Q3, which also would be the time for us to be ready with more capital. So in any case, I don't see anything much in calendar 20, but there may be opportunities as we open 21. We exit well and somebody else is willing to do a transaction, yes. But just now, consolidation, just doing the right stuff, making sure there are no credit issues, preserving capital, these are our principal focus. Holding out, and I hope that will continue.
Sure. I'll tell you why I asked, because, a lot of market participants that we chat with on a regular basis believe that perhaps Federal seems like a good merger candidate with perhaps a private bank, another private bank that is, with a different kind of a portfolio. And, again, the question comes in as to how is it that you increase the asset size of the business?
I think I've been in this job for 10 years. I think at least 5 of those 10 years I've heard this conversation. It sort of peaks and troughs every now and then. As we speak, nothing on the cards, Asha. Nobody has spoken. We are not speaking to anybody. If there is something, certainly the board will consider and then sort of do the needful. But just as we speak, like I mentioned, just acutely focused on getting the Q2, Q3 in good shape. And I think that will set us up for some good outcomes as we go into calendar 21 and beyond. All options are open. There's nothing that we can say no to if good opportunities come by. Like I keep saying, the next 100 days is just head down and do the right stuff.
Sure. So sans merger, how is it that you build up on the asset size of the business?
We've been growing at maybe 2x, 2.5x of the market. As you see, our share gain is quite considerable. In FY20, consciously we slowed down because of the environment. So should there be sort of things opening up again, we will certainly get back to our 15, 18, 20% growth, which is very possible. With our kind of liability franchise, CD ratio being sub 80, growth is not constrained either by capital or by liabilities. So I think growth is not such an issue. We must also be mindful, arithmetically, you add 1 and 1, it looks better than 2. But it has its own set of challenges. It's not like growth is instantly achieved only by merger. That said, like I have to say, there are many opportunities for us to buy portfolios, for us to look at small microfinance opportunities, look at small NBFCs. All options are open. But I do think at this very juncture, growth by itself is not the solution to everything. But we are certainly open, and the board will most certainly look at any option that is meaningful. We have to look at a range of things like fit, culture, people, and which geographies we are strong by, and which geographies whoever we are talking to. So I think this is as you would imagine, that this is a pretty elaborate conversation that needs to be well structured and well thought through. But all I have to say is that our growth is certainly not constrained by availability of either capital, geography, or liquidity, all of which is in abundance with us.
I have to ask you, Mr. Srinivasan, as I understand your tenure ends next year, like your larger peers, could you give us a hint whether it's going to be an internal candidate that you guys are mulling at?
Yeah, I think it's still a year away. By March, April, the board will certainly have a more constructive view on that. I would give that at least till March, April to sort of go into that space, but it has a very well planned out succession planning that is in place. So I don't see either lack of continuity or lack of candidates. So that's for sure. I do believe that by March, April, we will have much more clarity around it. And my term ends next September. So there's a good 13 months or shy of 13 months available.
My next question
Wondering where
would be,
is.
how disruptive are... Good morning, good to connect with you. I just got busy with the call, so my apologies, was not able to come in earlier. How you been? So good to connect with you. I hope all is well with you.
All is well so far, thankfully.
A lot of people, Mr. Srinivasan, they have one simple question, which is that you get a very large CASA, or in this case, I would say flows from Dubai or from the Middle East. Given where oil prices have moved, job losses has happened, is that something which is going to be a disruptive trend for you in future?
Nikunj, it's asked of us for many, many years, and if you'll allow me, we've done a lot of PhD in this, and our belief is that whenever there is any kind of dislocation in any of these geographies, we actually are a net beneficiary, as we were even in Q1 and even in Q2. And you've seen that numbers over years on 3-4 counts. One is we have a physical presence with our own people covering those geographies. We have a large diaspora base. Our client base is invariably people who have to, are not rate shoppers. They are more must send home money kind of profile. And when the rupee weakens, instantly the money moves into India. And every year, if you take the last 6-7 years, we've gained each year about 1% in growth in share. So I think the rate of growth, even if the NR remittances this year comes down by 20-25% as predicted, we may not grow at the same pace. We'll probably be at flat, which is still a great place to be in. So I don't see that as a singularly large disruptive area. That said, for 8-10 years, we've diversified our presence materially, right? When I joined our bank, NR was around 60% of our deposits. Now it's about 40. So which means the deposit franchise is fairly wide, and our non-Kerala presence is growing at about 25% a year. So I'd say the non-resident business is remarkably important for us. It's doing well. It should hopefully continue to do reasonably well. But we are reasonably well diversified across geographies and across product streams. And our our retail liabilities is, our total liability is 93% is retail. So we have like enormous room for other avenues. But it's a close watch. Having said that, oil has strengthened from where it was to almost 40, 43. So every time that happens, there's a little bounce back again.
You are an old private sector bank run by a new private sector management. That is my definition of Federal Bank. A old South Indian bank run by a new age private sector management, but unfortunately markets are giving you a price to book or multiple which is at a slight premium to a PSU bank. Why is that? You're doing all the right things. Why is that nobody is recognizing it?
I think we should, like, you wouldn't expect me to say anything other than the job is, management job is to do the job, right? The rest will follow. We were trading at 2, not very far back. Even at the start of this calendar year, we were almost 1.8. The more recent months have had its own consequences. I think it's only time before people realize that they missed the party. We are, like you said, our portfolio looks solid. Most important, I have to say this, in all my years, we've never had any financially numbers which we say are different from what the regulator feels. All our numbers are consistent. And our gross NPA has never crossed 3%. So the predictability is high. Our performance quality is good. Liability franchise is rich. I think these name tags, old, new, will shed itself, Nikunj. I don't see this lasting for too long. I think quality will show up. It's already showing up, and I'm quite convinced, if not now, by end of this calendar year, you will see us being right up there or closer to where we deserve. No, it's not a cocky statement. I genuinely believe that.
No, I just wanted to bring this point out just for the benefit of our viewers that here, in markets, sometimes you get opportunities and sometimes you also get serious bargains. Federal Bank may be one of those where markets for the moment are not recognizing it. So my last question, Mr. Srinivasan, is there is a consolidation happening in every sector in India, whether it is our sector, which is media, your sector, which is banks or NBFCs. Given that you have a presence in SME and the MSE space, where there is going to be a change or a survival challenge for a lot of these businesses purely because of the shape of the economy which is happening. How do you think that in a sense will affect and change your long-term trajectory? Because you are focusing on MSEs, you're focusing on SMEs, that's been a bread and butter segment for you, but guess what, the shape of the economy is changing that those businesses and companies may not be relevant after 4-5 years.
Great question. I think, sometimes, like you mentioned, this old private sector largely focus on middle and small income are names not created by the manufacturer, it's created by the environment. If you take our book and you take any slice of time, it's actually been a third, corporate, wholesale, corporate, small business and retail. When you divide by credit above 5 crores and credit below 5 crores, it comes to 50-50. If you divide by geography, where we were originally strong, and then pan-India, originally strong geography is about 25, rest of India is 75. So I think these are some things that are labels. Maybe it's our fault, we haven't sort of advertised it enough. But if you apply the more sort of conservative philosophy of just do the stuff, things will follow, you will find that our book is today, if you take the 125,000 crores, 45,000 crores is retail. That's about a 30%, right? If you take the corporate, it's about 50,000 crores. 10,000 crores is gold. So only the baki is what we call the small and medium establishment. So it's quite diversified. I don't think it's sort of any one geography or any one segment that we excessively dominate. We have strengths, which is certainly in the liability and certainly in the business banking segment, which is where we are growing into. That said, the book, like I said, is fairly diversified. And we can pivot the bank in any direction as the opportunities come. If you see the last 4 years prior to calendar 19, we grew our corporate book at about 23-24% CAGR. A, there was an opportunity. B, we had put up a very good team. C, we wanted to make sure that picks up while our retail comes in scale. Now retail is picked up. So I would say this mix of growing the businesses in geographies that we want to by the skill sets that we have developed, in my mind, will keep us fairly diversified across all these segments without the excessive focus. I genuinely believe, sort of highly going into either unsecured or very small ticket businesses are opportunistic and never a strategy. And we see why I've never gone into unsecured consciously. We traded off margin for quality. And we believe that any of these done at excess can have its own pain. So sometimes these conservative calls have a near-term downside, but situations like the pandemic should sort of escalate the goodness of such portfolios. So I do hope we will shine through this.
Well, really appreciate your time. Thank you for walking us through not just one aspect, but all the other aspects of Federal Bank and the banking industry. Stay safe and good to connect with you.
Thank you, Nikunj. Thank you, everybody. Thank you.